Have you ever wondered how Canadian tax residency is determined and what it means for your cross-border financial planning endeavors? Understanding your tax residency status is critical, as it directly impacts how your worldwide income is taxed. In this video, we'll explain how Canadian tax residency is determined and its effect on your cross-border financial planning affairs. Tax residency is a legal concept determining where you are considered a resident for tax purposes. It is not synonymous with your immigration status or citizenship. Therefore, an individual could be a Canadian citizen but not a Canadian tax resident. Canadian non-resident taxpayers are only taxed on their Canadian sourced income. Canadian resident taxpayers are taxed on their worldwide income. Therefore, it is crucial to first comprehend whether one has established Canadian tax residency before understanding its effects. The term resident is not defined in the Income Tax Act of Canada. Instead, Canadian tax residency is a question of fact and it is somewhat subjective. It depends largely on the nature and quality of the ties one establishes in Canada compared to those retained in the previous country. There are 4 different sources to consider: statutory provisions as stated in the Income Tax Act of Canada, common law principles established by the Canadian courts, Canada Revenue Agency's administrative pronouncements, and the use of an income tax treaty to override Canadian factual or deemed residency. Primary considerations in determining Canadian tax residency. The primary considerations in determining one's Canadian tax residency status focus on the location of home ownership, the whereabouts of the spouse or common law partner, and the domicile of the individual's dependents. Secondary criteria in Canadian tax residency determination include the strength of social and economic ties to Canada versus those established in the other country. Medical insurance from a province or territory, driver's license, vehicle registration, time spent in Canada, membership in Canadian clubs or organizations, history of tax filings in the other country, just to name a few. The CRA's NR 74 form, Determination of Residency Status, could be reviewed for factors the government considers to determine residency. Each individual's circumstances are unique. Therefore, it's best to review your scenario with Cardinal Point Wealth Management, an experienced cross-border wealth management firm. The initiation of Canadian tax residency has serious implications that reverberate throughout the entire cross-border financial planning world and your matters. Upon establishing Canadian residency, all taxable investment assets are subject to the deemed acquisition date, whereby a new Canadian cost basis is established relative to the value of each investment and the currency exchange rate on the date of Canadian tax entry. If the individual also maintains U.S. immigration ties via U.S. citizenship or green card status, then separate sets of cost bases for both U.S. and Canadian tax purposes need to be accounted for. At Cardinal Point Wealth Management, we track both sets of cost bases and produce separate realized gain-loss reports for assets under our management for Canadian tax residents who maintain U.S. tax ties. Furthermore, triggering Canadian tax residency requires an adjustment to the investment management architecture coinciding with tax efficiencies that are consistent with a shift to Canadian tax residency status. Triggering Canadian tax residency starts the reporting of one's worldwide income to the CRA. The Canadian tax implications of IRA withdrawals, U.S. Social Security payments, future sale of a foreign rental property, and U.S. royalty income are a few examples of income sources where CRA tax implications need to be assessed and quantified. In addition, certain U.S. tax advantage accounts, such as college 529 plans and health savings accounts, lose their tax benefits from a Canadian tax perspective unless careful planning has been done to alleviate those issues. Moreover, in the US, married couples can file jointly. However, in Canada, spouses need to file on an individual basis. Therefore, the development of a tax strategy centered on equalizing the spouse's investable assets, where possible, prior to Canadian tax residency is essential. Canadian tax residency also prompts a reconfiguration of cross-border retirement income and estate planning tactics. Canadian registered accounts such as RSPs and LIRAs become fully taxable when the surviving spouse passes, potentially resulting in a 50% or more death tax. With the goal of maximizing what goes to the family and minimizing what goes to the CRA and the IRS, a revamped retirement income strategy is imperative as a Canadian tax resident. The Canadian death tax should be quantified and a plan formulated to reduce exposure. Furthermore, convenient U.S. trust-centered estate plans pose significant double taxation issues as a Canadian tax resident. Since estate laws are governed by the state or province in which one resides, the effect of initiating Canadian tax residency requires a complete update to one's estate planning affairs relative to their legacy aspirations. Determining your Canadian tax residency is a critical step in managing your financial obligations both in Canada and abroad. By understanding how your ties to Canada are evaluated, you can make informed decisions and avoid potential tax issues down the line. The effects of Canadian tax residency necessitates integration of your cross-border financial planning affairs. Contact Cardinal Point Wealth Management to examine your specific scenario. Thanks for watching and safe travels. If you find this information helpful, don't forget to like, share, and subscribe for more insights. Stay tuned for more timely advice on managing your cross-border financial and tax planning needs.